Every time traders lose, they always say the same thing. It was market manipulation, right? Stop hunts, all of that. But the truth is, market manipulation doesn't exist, at least not in the way that you're thinking. And if you believe that, then psychologically it's holding you back from becoming a profitable trader. Take this bit of price action, for example, right? If your bias was long here at the beginning of the morning, and you ended up taking a buy position off of something that you saw in here, placed your stops down there, you take profit there, right? This used to frustrate me all the time, right? Stop hunt, right? It takes you out right where you put your stop and then immediately goes to where you had your take profit, right? Or even here a little later on in the day where we have price flipping bullish after a kind of bearish run down. We have price flipping bullish, pulling back, going back up, and so you might say to yourself, hey, I want to get involved on a pullback of this little leg, place my stops here and my profits here for a 2-to-1, and you get stopped out. The price immediately goes back up to that level that you were targeting. Here's the reality. Institutions, big banks, people with millions and millions, if not billions of dollars that they need to transact, they need liquidity in the market, right? So what retail traders call manipulation, banks just call liquidity. If you think about it, when you press buy, you need the equal amount of sell orders on the opposite side in order for your trade to be filled without slippage, right? And if we take this bit of price action, for example, let's imagine that, say a bank needs to trade $100 million worth and they want to buy today, so they need $100 million worth of sell positions on the opposite side. Now, what do retail traders usually do, and what are people usually taught? When you take a position, you place your stop losses and take profits at these structural levels, right? These highs and lows, these peaks that you see all along the chart. So there's resting liquidity everywhere along the chart, but mostly concentrated at these peaks of price. So if a bank needs to trade $100 million, for example, maybe $10 million worth, let's say 10 million. 10 million might be sitting here, and another 10 million might be sitting here at this level, and another 10 million might be sitting here, and another 10 million might be sitting down here, and another 10 million right at this small level. And you have all these little clusters of orders along price where you have sell orders on the opposite side of where the bank needs to go. So what happens? A bank says, I need to transact $100 million worth today, which means I need to drive price into the liquidity pools that I need in order to have my position execute. So what happens in the morning here? Price dips into this level of liquidity, and you know what? Let's use a green graphic here. We'll say there's liquidity at this level. Boom. Buyers get in. Maybe that was 10 million there. As price comes up, there's more liquidity at this level here. Now remember, the institution needs to buy. So what does that mean? They need sell orders. So who has sell orders here at this level? There may be buyers who set their take profits here. These are sell orders. Or there just may be people that think the market is bearish this morning placing their sell limit orders here at this level. All right. And so as price comes up into here, institutions buy that up again. Now, keep in mind, they bought here and they bought here. So the dollar cost average price so far is somewhere in here, somewhere in the middle. The dollar cost average for the institution now, depending on how much they bought here, maybe it was 10 million here, 10 million there. Maybe it was 20 million here, 5 million here, we don't know. That would then put their dollar cost average, a little lower or a little higher. Point is, the average price is between there somewhere, right? So, and let's move this out of the way slightly and continue on in price. As price is driven down here, right? You have another small level of liquidity in here. And again, these institutions are looking for sell positions, meaning you may have buyers who bought off of this break of structure thinking price was going to continue up, right? And when price ended up continuing down, they sold off their position, right? Because it was too much of a drawdown, or maybe they had stop losses placed somewhere down here. And so those stop losses and those sell orders that are down here also get swallowed up. So now what are we looking at? A buy position here, a buy position here, a buy position here. That means dollar cost average still is sitting somewhere around this level. And as you can imagine, as price continues, and let me just kind of clean up these lines here. As you can imagine, as price continues, we see levels of liquidity all over the place. There's liquidity there. There's liquidity here. Price comes up a little bit. There's technically going to be a little bit of liquidity there. There's going to be a little bit of liquidity here, possibly even some orders below this level, orders above these levels, right? You get the idea, where there's liquidity resting all over this chart, right? And so for a retail trader, they're thinking, man, my orders are being manipulated. My trades are just being stop hunted. But in reality, what do we have? We have maybe an institution buying 10 million here, 10 million here, 10 million there, 10 here, 10 million there. That's 50 million total. They needed 100 for today. So then they get another 10 there, 10 here, so that we're up to 70 million, 80 million off this level, 90 million, and then 100 million, right? Let's just assume in this hypothetical example that there's $100 million worth being bought at all of these liquidity levels across, what is this, from 9:30 to about noon today. And depending on the volume that they bought at each of these levels, their average purchase price, it averages out of, this entire range to, let's say it's somewhere in the middle. That's what their average buy price is. So now, as price gets driven up here to this level of liquidity resting there, what do you think happens on the opposite side? The institutions need to exit $100 million of their position. Now, unless there's $100 million worth of liquidity sitting up here, an institution will have to do the same thing again in order to get out of their position. Meaning, as price gets drawn up to this level, right, there might be $20 million worth of liquidity, which then creates more liquidity at this new high. And price might come in here and stop hunt, which really is just liquidity, right, to take this out. And then price might play around and then come down into this level some, and then traders may think, hey, we're in a downtrend now. And so what does the institution do? They take some more liquidity off of this level that's now formed. They take some more liquidity off of this new level that's formed. Maybe come off, take more liquidity at this level that's formed, more liquidity at this level, and the last of their 100 million at this new level, and then you see price melt. And so a retail trader is sitting there thinking, man, I wanted to sell at this level. I sold here, right? And I got stop hunted. So then another trader might say, oh, I bought here and got stop hunted, all right? When in reality, what's happening? Liquidity is sitting there. Liquidity is sitting there. Liquidity is sitting there. Right? You get the idea. Where at all of these levels, we have resting buy side and sell side liquidity. that institutions need in order to get out of their previous positions. And these big swings in price that you see, these long swings, what that indicates is that an institution or whoever the big players are with the most amount of money in these orders finally had their position liquidated. So the next time you get stopped out, right, and you see price immediately rally back to where your initial target was, right, just understand that that's how the markets move. They're searching for liquidity, the same as you. So if you can anticipate and keep in mind that this is how price moves, institutions search for liquidity, then you can start trading with the flow instead of trading against it. So, drop a comment down below if this made sense, if you understand this concept. I know there's a lot of talk about liquidity and about stop hunts and manipulation and all that, but the reality is big institutions need big sizes on the opposite end of their orders, and the only way they do that is by collecting liquidity from everywhere that they can get it. So let me know if you learned anything from that video, or if you liked the video. I like to kind of look at the market holistically and understand what's actually happening behind the price action, right? Because markets don't move because of patterns. Markets move and then form patterns. And so it's something that over time you get used to seeing, and you understand, hey, the market's not out to get me. It's just the way it moves. So like and comment down below, and we'll be back next time.